Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Jan Nevruzi and Giles Gale. Okay, Jan, I'm going to kick off straight with you because we're recording this hot off the latest CPI print, which came in lower than expected, and it's driving a big move in markets this afternoon or this morning for you on Thursday. So talk to me, what drove that kind of downside surprise?
Yeah, like you said, it was a very welcome development. Inflation came below expectations. Just to give a couple of numbers for context, the headline monthly number was 0.4, which equates to 7.7% on a year-on-year basis versus 0.6 expected. So certainly a lot below, what market pricing was looking at, and general Bloomberg consensus from economists was looking at too. Similarly, the core component was a soft 0.3, so like unrounded was something along the lines of like 0.27. It's certainly showing downtrend, and I'll go into within the components in a second too. But overall, pretty good news, and the market reaction was appropriately, price led to a massive bond rally and general fixed income rally and a massive stock rally too, as maybe prematurely, maybe not, but market participants sort of extrapolated that this means that the worst of inflation might be behind us. And a little bit digging into the components that drove the relative slowdown compared to last month. And it's still important to point out that inflation is running at a high pace. It's just we're seeing a slower rate of increase. So the second derivative there is showing a decrease, which is, of course, kind of what the Fed is looking like now. No one is expecting inflation to come back to target very soon anyways. But I think three main things that I'll focus on within this inflation report that helped bring the release lower. First is generally what's called like the housing component, the rentals and owner's equivalent rent, OER. OER makes 25% of the index in itself, and that showed like 0.2 of a decrease compared to last month. And that's good news because we have discussed before, and media picks this up too often, that the CPI housing measures or like rental measures are lagging what's happening in the spot rental markets with new rents. But we didn't really have a good answer of when that peak would come. So if we saw an acceleration again this month, it could have implied that there's more to come, and your whole inflation profile just shifts a lot more to the future. And because it is very unlikely for us to see rents collapsing within the CPI from 1 month to next month. If it goes to 0.8, it's not going. We're just not going to see the scenario where it's suddenly 0.5 the month after, or 0.3 after that. That rapid decline just doesn't occur by design. So that was one, and it shows that perhaps the peak in the rate of increase in shelter has arrived. The second was the medical care component that came below what we had expected. We were looking for a decline, and it is mostly due to how medical care component is measured. I'm not going to get too much into the the calculations there, but the important thing is that the component about insurance premiums of insurers gets reset in October, and basically the BLS carries that number almost equally across the entire year. And this reset showed a much bigger decline than we would have expected. So that was down 0.5 percentage point on a monthly basis, and it will provide a drag to inflation over the next 12 months as well. So that's certainly good news. And finally, what used car prices are now taken away too. Remember, like a year ago, we were seeing this 10% monthly increase in used car prices. That was almost the reason for the transitory rhetoric that was introduced. Now they're going down, and we had seen in alternative data providers like Manheim and JD Power about car price transactions showing decline. It was only a matter of time, and looks like that the matter has occurred now. And now is when we're starting to see the declines. We saw about 2.5 percentage point decline in the used car prices. So even though they make smaller parts of the overall CPI index, big drops like that, will have a relatively outsized impact. And if this trend continues, it's certainly something that the Fed will welcome.
Okay, I guess that leads us nicely onto the discussion of what this really does mean for the Fed then. This is obviously one of two inflation prints that they will have before the December meeting. But does this nail on 50 basis points, you think?
Yeah, I think so. And let me make again, 3 is a lucky number today, so I'll make again 3 points around that. I think are my main takeaways from inflation with respect to Fed. Of course, 50 basis points for December looks a lot more likely. So that's one. A tail risk of 75 or even 100 has been clipped. I don't want to quite rush and say 75 is not possible anymore, but it sure looks like it. 50 is a very safe bet for December for now. So that's one. And the second thing is, how we talked last week about Fed not promising, but pretty much alluding to 3 things. Lower pace of hikes in December, longer period of hikes, so higher terminal rate, and stay there for longer. So the first one is looking like very likely in December, lower pace of hikes at 50. But the other 2 things of reaching a higher terminal rate, so like something above 5% or staying there for longer, are now looking slightly less likely compared to, say, yesterday. So I think that's pretty much the reaction, the market's market's reaction, a broad-based kind of like rally and a steeper curve as front end tightening got priced out. So and the final point before the Fed, I think I need to outline is, while this is good news, I think we shouldn't be looking at this as and saying the problem has been solved. We have another inflation number before the December meeting during the Fed's blackout period. We also have another jobs number. So there are still variables going in there, and we will see the dots as part of the quarterly projections of the Fed, what the Fed people expect for their forecast for next year's and beyond for Fed fund rates. So today's number certainly makes it less likely to go above 5%, but if we get a reacceleration in December with the next CPI number, who knows? And that will certainly be determining the next leg of market repricing.
How does that leave your rates views then? And I guess regular or long-time readers will know that we are currently in the process of updating and refreshing all of our views and forecasts for our year ahead. So a bit of a shameless plug there. We'll be publishing that for subscribers of our research next week on Friday. But how does this leave your rates views currently, notwithstanding the fact that they might be tweaked a little bit over the next week or so?
Yeah, so over the past few weeks, we had scaled into steepeners in like real yields in anticipation of similarly seeing them at like above 1.5% look pretty attractive to us. So we did see generally lower, longer dated real yields. That worked out pretty well today after this release. Into the year ahead, we are also talking about more cycle reversing trades like 530 steepeners. That of course gained a lot today, but we won't have that published until next week anyways. In any case, our view of rates topping out around here, and it is one of our key themes going into next year, seem to be proven right by today. And I don't want to turn this to have like a short shelf life, but for now, it certainly looks like the pressures are turning to downside in rates as opposed to and to steeper curves as opposed to flatter and higher.
That's in the US, but what about in Europe then, Giles? This pivot theme hasn't just been a US focused one. As we know, the US often leads the way, but it feels like global markets have kind of latched onto this idea that a pivot might be underway. How are you thinking about that in Europe? And does today's US inflation print change anything for you? Does that scale back your expectations of a hike from the ECB in December? How are you framing your thoughts now?
Yeah, so the Fed always puts pressure on other central banks, of course, most obviously via the currency, as we well know. But we have been looking for a lower profile than the market has in mind for some time now. That's something I've been repeating for a while. Our base case is that the ECB actually stops at around 2.25. I think that the risks are clearly on the upside against that, but I think that compared to where we started the day, at the very least, there was certainly a lot of room for a slower and lower ECB path. But whether that means an out-and-out pivot, I mean, I suppose define pivot really. I mean, if that just means pivot to a slower pace, then that was already a meeting away, to be honest with you. I think that it's important to just notice some of the differences, though, in the economic inflation environment in the US versus Europe. And until now, we've tended to accentuate the more inflationary, or sort of domestically generated inflation that we've had in the US. But it's interesting to see, for example, Schnabel had a speech today that picked up on a Bank of Ireland study of wages, wage trends, sort of in real time, taken from job ads, which pointed to higher wages to come, particularly in Germany. And then that was followed up by the economic bulletin, which just a couple of things that I would draw out from that. One was their chart on the underlying inflation measures, which really do look strongly skewed to the upside compared to where we are now in sort of headline core inflation. And there was also a report in one of their little boxes where they talk about the findings from their discussions with firms, and the intelligence from the real economy from those discussions was really that they see higher ongoing wage pressure well into next year.
It's been a busy week for ECB speak. And we touched on this briefly, I think, last week, or certainly in the UK context, but away from, I guess, just the direct discussion around whether they're going to hike, how high they're going to hike rates to or not, and QT and things like that. We've also obviously been focused on, funding stresses at the front end, and this idea of collateral scarcity and the measures that the ECB could or might introduce to alleviate those pressures. Today, they announced that they have made changes to their securities lending program. Does that mean anything? Will that go any way to kind of help those pressures that we've seen at the front end?
Yeah, so the details were that essentially they make the securities that they've bought in their various QE programs available for lending, both against other bonds and against cash. And what they did today was to raise the limit that they will lend, the total limit that they will lend securities against cash from 150 to 250 billion euros. And yeah, I do think that will make a difference, particularly for bonds. Essentially, as was 150 billion, it was never being used fully, but that's partly, I think, because that wasn't 150 billion for what the market wants. That was a total at the aggregate level, and then that needs to be apportioned by country, by national central bank, according to something like a sort of modified capital key. And so the maximum amount of bunds, which is really what the market's short of, that could be borrowed, was probably significantly below that, and may well have been close to binding on a regular basis. And so just by raising that ceiling, I think that they do ease a constraint. So I suppose that there's an open question why they didn't raise that much further, given that draining reserves is no longer an issue in this sort of tightening monetary policy environment. I think that there may be some questions about interference with TLTRO repayments, and it may just be that they're seeing how much reasonable increments, how much difference they can make, and they'll take it as they go. So I do think they could increase this further. But above all, I just think that this shows some sensitivity to the collateral shortage theme. So just, I guess, flexing what they already have in place before doing anything new. But I don't think that this means that they don't have anything new if that should be needed.
And just to round out the discussion on Europe this week, then, we were just talking to Jan about the US CPI print, and I was saying that's been a kind of major global market mover. We're seeing BTP spreads, or BTPs rather, yields rally about 20 basis points, I think, when I just left the desk to record this. So there's clearly a more kind of positive tone in credit. Is it just being driven by the inflation print? Is there more to it than that? And do you see this kind of sustaining into year end?
No, there definitely is more to it than just that. Clearly BTPs are loving this, I guess, lower rates and sort of slower rate rises theme. But I think, playing into that, you've got, you've got the US inflation, you've got lower rates. This is all good news. As we've discussed in recent podcasts, there are no domestically sort of negative stories coming out of Italy just at the moment. There was I suppose it was earlier this week, actually, wasn't it? This story of a budget increase, the new deficit target being 5.6% for this year. But let's say no political trauma, supply concluding for the year. We have lower volatility overall, or at least the prospect of it, in rates. And I think there's also adaptation to this idea that there's a little bit less energy panic as well. So, I think that there is every possibility that we may actually end up at the end of this year tighter than 200 basis points in BTP Bund spread. So, I think that can continue to follow through. So, with that, let's go back to you then and talk a little bit about the UK. So last week we spoke a little bit about the collateral scarcity theme in the UK context and stress in funding markets and so on. In fact, it seems like it's made you famous in possibly the most niche way possible. I always assumed there may be maybe a more glamorous route available to you, but let's not get too hung up on that. How's that developed this week?
I always thought it would be Bondcast that made me famous, not my views on what the Bank of England can do in funding markets. But there we go, take what you can get. So actually, for all the kind of focus that we were giving it last week and the note that I wrote on Monday morning, it feels like those pressures have alleviated a little bit in the UK this week. Now, part of that could just be due to supply. We've had a really heavy supply outlook this week. We've had a really heavy supply week. We had a lot from the government side. We had 3 issues from the government, one of them being the new 15-year syndication. We obviously had the QT auction as well at the beginning of the week. But also, I guess more importantly, we've had credit markets reopen a little bit. We've seen some financial issuance. We've seen just generally a heavy week for issuance, which might have helped, I guess, alleviate some of the pressure that we were seeing. I guess the conclusion that we sort of alluded to last week, and I think that anyone who's read our note will have read that, it felt like we've reached the point where the Bank of England were now starting to take notice of what was happening, and perhaps we were getting to a point where it was close enough, or that they were thinking about the ways that they might intervene. Now, that means that it probably feels like fairly one-way risk in front-end swap spreads at the moment. Either the market kind of resolves this of its own accord and market forces alleviate some of the pressures that we were seeing, or the Bank of England step in. I think probably if we're talking about the Bank of England stepping in, the most likely kind of intervention, if you like, at least in the first instance, is for some sort of repo facility, and a lot of people have been referring to this as a kind of Fed style RRP, but perhaps more likely as one that's a bit more size and time limited, unlike the Fed, but essentially works in the same way, and that could be implemented fairly swiftly and at least would help with kind of pressures that we might experience over the year end, over the turn. An alternate and perhaps more long-term and maybe more permanent solution is that they could actually just start selling the bonds more quickly that they have on their balance sheet, or even just start selling the very front-end bonds. One of the key features, I think, of the short bond auction that we had 2 weeks ago was that it was the shortest bonds in that bucket, so the kind of 3-year bonds that were the most bid. Part of that is because one of those bonds will now roll into the sub-3 sector and therefore won't be sold. But the Bank of England could easily extend that bucket, so they have a kind of longer maturity. Instead of being 3 to 7, they perhaps sell 1 to 7, let's say. Or they could just create a whole new bucket, which they also sell in regular auctions. Obviously, that doesn't kind of alleviate the problem as quickly as setting up a repo facility might, but perhaps the two could be combined over the longer term to create a more long-term solution.
Okay, right. So with that, let's think a little bit about next week. So there's lots of data. What do you think the markets and the Bank of England are going to be focused on there?
Yeah, I guess the highlight really will be the inflation print. Obviously, that comes hot off the heels of the Fed today, not the Fed, the US inflation print today. But slightly differently, I suppose, we see quite a jump still in headline CPI. I guess importantly for the kind of profile of the forecast, we expect the October print that we get next week to be the peak. So we have 10.6 in headline CPI. That's up from 10.1 last month. Core we expect to edge down slightly, so it'll be 6.4. That's versus 6.5 last month. But I guess the important point here, and perhaps particularly relevant when we're thinking about, is this a pivot or is it not, and what really is a pivot, is that we still expect inflation to be very sticky for the next couple of months. So even though we think we might have seen the peak in core inflation, and we think that this will be the peak in headline CPI, we pretty much have them both sticking in their current ranges, 0.1 of a percentage point either side of that. For the next couple of months, still in February, for example, in our current profile, we have inflation above 10%. So the peak may well be coming in, but I don't think that you'll be able to kind of conclude from next week's figures that the Bank of England will be confident enough, I think, to take their foot off the gas in any kind of material way. To the extent that they felt justified to step up to a 75 basis point hike in the November meeting, largely off the back of the data and the fiscal stimulus. It's difficult to see if we do get headline CPI coming in at 10.6% next week, how they will justify kind of taking their foot off that accelerator and stepping back down to 50 when the fiscal stimulus is obviously still there and inflation is still very high. We'll also get labour market data. That's probably the other kind of key data that the Bank of England are watching. And before then, although I won't talk about this too much because we get that tomorrow and everyone will know what the print is, but just to flag that we also have GDP data, which we expect to be weak and therefore set the economy on course for a technical or an official recession in Q3 and Q4. So it's a bit of a mixed bag, I guess, in terms of the data, because we're expecting the kind of growth to be pretty weak, but inflation still stays strong. But I think together it's probably enough at this point to keep your expectations for the Bank of England at 75 basis points in December.
Okay, and I guess the other thing that's happening next week is it's the budget next Thursday, of course. Lots of talk in headlines about spending cuts and tax cuts. So maybe you can just run us through what you've heard and what you think about all of that.
Yes, finally, we're back at the budget week again. Like you say, there's been a huge amount of focus, I suppose, around the fiscal gap or the fiscal black hole that Hunt's going to try and fill, and how he's going to fill that with different spending cuts, different tax hikes. I guess the very kind of near-term implication for markets is that most of the policies that we expect him to announce when it comes to spending cuts and tax hikes are not going to be immediate. He'll be looking to close this kind of fiscal gap over the next 5 years. And so although I think that this is fiscal tightening versus where we were 6 weeks ago, or even less than 6 weeks ago. The immediate implication for the government financing needs are actually quite minimal. We still have very high financing needs for the remainder of this fiscal year and for the fiscal year ahead. And although we might get marginal tweaks to that on Thursday, I don't expect that to kind of materially alter the supply outlook, which, as regular listeners will know, is increasing. And I still think, and especially today, given how much yields have rallied off the back of this inflation print, I think that markets are overpricing this idea of a pivot in the UK and underpricing how much supply is about to come on board and who's going to be able to take down that supply. So there's definitely going to be a lot of focus on spending cuts, the tax hikes, but I don't think, for the near-term picture, I don't think it's really going to alter very much. I will say one of the headlines that we've had overnight is that this 8% surcharge on bank profits that was maintained in the mini budget, Hunt is looking at potentially cutting that to 3%. Again, it's not fiscally hugely important. It only raises about $1 billion a year, keeping it at 8%. So cutting that isn't going to be a game changer for the government finances, but perhaps at the margin, we've been talking a lot about the potential for tiering, and actually our base case was that tiering, given that this is about redistributing bank profit essentially, or recouping bank profit from the interest that they earn on reserves, actually falls under the bracket of fiscal policy rather than monetary policy, and therefore we thought a kind of easier and cleaner way of implementing or at least reaching the same end as tiering would be to implement a windfall tax. But if he's thinking about cutting the surcharge on bank profits, then I think it makes a windfall tax pretty unlikely as well. I will stop there though. I kind of flagged it already earlier, but the other exciting thing that's happening next week, apart from all that data in the budget in the UK, is that we will be publishing our year ahead. So anyone who subscribes to our research, please do look out for that. And I'm sure that there will be a year ahead Bondcast special on the way. But until then, just to remind everyone that if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.